Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and The Challenger go head-to-head on Lock In Now, why a fixed-rate mortgage is the only rational choice while the world burns. Let's get into it.
2-year fixes at 4.14% might look expensive with base rate at 3.75%, but in a world where the Iran conflict has already pushed average mortgage rates above 5%, locking in now is the only rational move.
Rational? You're asking people to pay a £3,800 FIR premium over 2 years compared to a tracker at base plus 0.75%, and that's assuming the Bank of England only cuts twice more to 3.25%.
That £3,800 figure assumes rate cuts that haven't happened yet. You're treating MPC forecasts like guarantees.
And you're treating geopolitical headlines like they're permanent. Iran is a distraction, not a trend. Oil shocks cause temporary spikes, not sustained rate hiking cycles.
Temporary? Barclays and Nationwide have already pulled their sub-4% deals. Gilt yields are hovering around 4.43% and swap rates are climbing. The market is pricing in sustained uncertainty.
Swap rates climb and then they fall, that's what markets do. The base rate trajectory is down, not up. Every serious economist agrees we're in an easing cycle.
We were in an easing cycle. One escalation in the Strait of Hormuz and your easing cycle goes into the shredder. The Iran premium is real and it's not fully priced in yet.
So your argument is that things could get worse than the market expects. That's always true. It's not a mortgage strategy, it's just anxiety.
No, my argument is about what a rate hike actually does to a family budget. On a £250,000 mortgage, every quarter point rise on a tracker adds over £30 a month. 2 unexpected hikes and you're £750 a year worse off with no way out.
But you're ignoring the other side. Every quarter point cut saves you that same £30. And cuts are far more likely than hikes right now. You're only running the disaster scenario.
Because the disaster scenario is the one that matters. Nobody remortgaged to save £30 a month. People fix to make sure they can still pay their mortgage if the world surprises them.
Fair, certainty has value. But you're not mentioning what that certainty actually costs. A 2-year fix locks you in with early repayment charges, typically 2 to 3% of the balance. That's £5,000 to £7,500 you can't escape if rates drop sharply.
And a tracker exposes you to unlimited upside risk with zero protection. At least with IRSs you know the maximum downside before you sign.
Unlimited upside risk. The Bank of England would have to hike to 5% or higher before a tracker at base plus 0.75% even matches today's fixed rate. When did they last go to 5%? Briefly. In a crisis they've since unwound.
You mean the crisis we might be heading into right now? Gilt yields at 4.43% are telling you something. The bond market doesn't panic for fun.
Gilt yields reflect global risk appetite, not domestic rate expectations. The bond market is also telling you that long-term rates are expected to settle lower. The yield curve inversion makes that clear.
You're cherry-picking which signal to trust. When gilt yields support your case, they're gospel. When they don't, suddenly it's just global noise.
I'll give you that. We're both reading the same data differently. But here's something we can agree on. Brokers earn bigger commissions on fixed-rate products. That incentive shapes the advice people get, and nobody talks about it.
I'm not defending broker incentives. But a misaligned commission doesn't make the product wrong. A fixed rate is still the right choice for anyone who can't absorb a payment shock.
And I'd agree with that for someone with no savings buffer and no flexibility. But for most remortgagers with equity and some financial resilience, paying a £3,800 premium for psychological comfort is a bad deal.
You keep calling it psychological comfort like that's a frivolous thing. The stress of watching every MPC meeting wondering if your mortgage payment is about to jump, there's a real cost to that.
Sure, but you could offset that stress by putting the £150 a month you're saving on a tracker into a savings account. If rates spike, you've built a buffer. If they don't, you've made money.
That requires discipline most people don't have. You're designing a mortgage strategy for a perfectly rational actor who doesn't exist.
And you're designing one for the most anxious actor who does. Look, the maths favors the tracker in almost every scenario where the Bank of England doesn't hike 3 or more times. That's the base case right now.
The base case right now, those are the key words. Right now can change overnight with one missile strike or one inflation print. And when it changes, tracker borrowers have no shelter.
When has right now ever not been uncertain? There's always a reason to fix out of fear. In 2024 it was inflation. In 2023 it was the mini-budget hangover. The fear premium is always for sale.
And in every one of those cases, the people who fixed slept better at night while markets whipsawed around them.
They slept better and woke up poorer. That's the trade-off, and people deserve to know the price tag before they sign.
In the end, a fixed rate at 4.14% is the price of knowing exactly what you'll pay for 2 years while the world burns around you, and right now, that's a bargain.
And a tracker at base plus 0.75% is a bet on the most likely economic outcome actually happening, instead of paying thousands to insure against a scenario that probably won't.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.